Welcome to today's Explainer, where we're diving deep into the tantalizing but honestly pretty perilous world of proprietary trading firms. Look, if you've been anywhere near the trading space lately, you've definitely seen those flashy ads. You know the ones, promising hundreds of thousands of dollars in funding. But behind those massive payout screenshots lies a very complex and sometimes totally unforgiving industry. So let me ask you a provocative question right out of the gate. What if the rules of your funded account were actually designed to make you fail? Because the reality of securing those massive prop firm payouts is a lot darker than their marketing departments want you to believe. Today, we're going to expose the hidden mechanics of this industry, look closely at the fine print that trips up even veteran traders, and arm you with the strategies you actually need to survive and get paid.
Here is exactly what we're covering in today's Explainer. We'll start with the prop firm promise, then how prop firms actually profit, hidden traps and vague rules, comparing top prop firms, protecting your prop payouts, and finally, winning with VWAP strategies.
Okay, Section 1. The prop firm promise. Trading without capital risk. The ultimate dream they're selling you here is accessing hundreds of thousands of dollars in capital without risking your own money.
To really grasp how this landscape works, we have to define the two main entry paths. You basically have two doors you can walk through: instant funding or evaluation challenges. This is the very first critical decision you have to make. You either pay a premium to skip the testing phase completely, or you pay a smaller entry fee up front and prove your skills by hitting specific profit targets first.
It's a classic trade-off. Instant funding gets you right to the money, but man, it is expensive. Evaluation challenges are much cheaper, but they demand your time and flawless execution through one or two testing phases. Regardless of the path you choose, you are still paying a fee up front just for the privilege to trade their simulated capital.
Moving on to Section 2, how prop firms actually profit, the house edge. This is crucial. You really need to understand how these companies are actually making their millions.
Take a look at this number, 73%. Data sourced directly from GOAT-funded Trader reveals a staggering 73% of traders fail simply due to hitting their daily loss limits. Think about that for a second. This proves the entire business model relies heavily on failed challenge fees. The majority of a prop firm's operating revenue comes from traders paying for challenges, failing, and then buying another one. It's an incredibly lucrative system simply because most people fail.
Which brings us to Section 3, hidden traps and vague rules. Subjective denials. Let's say you're in the minority that actually passes. Getting your payout is a completely different battlefield.
Listen to this fine print from FTMO, which is one of the biggest and oldest firms in the entire industry. They state, traders must not engage in practices not reasonably replicable, including opening substantially larger position sizes. Notice the wording there? There's no hard number. The term substantially larger is totally subjective. Traders across Reddit and Facebook are consistently reporting that after following every single published rule and hitting their targets, their payouts are being denied because the firm just retroactively decides they risk too much per trade.
And it's not just vague terms. We are talking literal trapdoors here. For example, Funded Squad has a strict 2-minute minimum trade duration. Close a trade in under 2 minutes? Boom, it's a violation. Then you have GOAT-funded traders, GOAT Guard, that auto-cuts your trades at a 2% loss. Sounds helpful, right? Well, it results in a soft breach that drastically reduces your profit split. Throw in weekend gap profit deductions and consistency rules, like Funded Friday's 15% rule that actively punishes you for having one massive winning trade, and it's a minefield.
But get a load of this double standard. The 2-minute scalping rule found at several firms is wild. If you close a winning trade under 2 minutes, they cancel the profit or just breach your account entirely. But if you close a losing trade under 2 minutes, oh, don't worry, that loss is fully counted against your daily limit. It's literally heads they win, tails you lose.
Let's move to Section 4, comparing top prop firms, the buyer's guide. Knowing these rules absolutely changes how you should choose your trading partner. Breaking down the major players, you can really see the differences. Consider Funded Squad. They offer a very low 8% target and a generous 7% max drawdown, but you've got to dodge that scary 2-minute rule we just talked about. Contrast that with Lucid's Flex plan, which has literally zero daily loss limit and allows payouts after just 5 days of hitting a mere $150 profit. Or FXFI, which is heavily optimized for crypto traders looking for high volatility leverage up to 200K. You have to match your specific trading style to the firm's fine print.
All right, Section 5, Protecting Your Prop Payouts, the Defensive Playbook. Knowing the traps is only half the battle. You need a rock-solid defense.
To build that defense, check out the Prop Farming Diversification Blueprint from Blue Edge Financial. It strongly advocates for radical diversification. You spread your capital and operations evenly across multiple firms, 25% here, 25% there. Why? Because if one firm abruptly changes its rules, collapses out of nowhere, or hits you with a vague payout denial, it doesn't wipe out your entire business. You are eliminating that single point of failure.
To survive, you need to follow this payout protection checklist religiously. Don't just skim the trading objectives, read the Forbidden Practices page word for word. Search Trustpilot, but only look at the most recent reviews for payout complaints, ignore the overall historical score. Check Reddit for denial patterns. And mathematically, follow Kimmel Trading's advice here. Once you're funded, drop your risk to just 0.4% to 0.8% maximum per trade, and never, ever trade more than 30% of your accounts at the exact same time. Treat your funded accounts strictly as capital preservation machines.
Let's wrap up with Section 6, Winning with VWAP Strategies, Live Execution. To actually secure those payouts without blowing your drawdown limits, you need a high-probability strategy.
A tool highly recommended by professional prop traders is the VWAP. That's the volume-weighted average price. This isn't just your basic moving average. It actually factors in volume, acting as the ultimate anchor for market value. It literally shows you the exact price level where buyers and sellers agree. Think of the VWAP as an immediate compass for the market's direction. A rising VWAP tells you buyers have the volume and the control, so you should be looking for it to act as dynamic support. A falling VWAP means sellers are aggressively in control, and you should look for the VWAP to act as resistance. And if it's flat, nobody is in control, and honestly, you should probably just sit on your hands and stay out of the market. So setup number 1 is the VWAP rejection. You wait for an extended price retracement pulling back right into the VWAP line. But you don't just guess, you look for visible price exhaustion. Think really small candle bodies or long wicks that show rejection. You enter the trade right there, keeping your stop loss incredibly tight just on the other side of the VWAP, expecting that dominant trend to resume.
Setup 2 is the breakout. Here, you're watching the price repeatedly knock on the door of the VWAP. The price structure starts to compress, building higher lows or lower highs, basically tightening up like a spring. You enter the trade right as a strong momentum candle breaks through the VWAP, establishing a brand new trend.
And our final technical strategy is the overextension. The market acts exactly like a rubber band. When an aggressive move stretches the price incredibly far away from the VWAP baseline, it is mathematically bound to snap back to where the market agrees on value. You spot that decreasing momentum at extreme highs or lows and take a quick scalp trade anticipating a snapback reversal.
Well, we've officially exposed the casino's secrets. You now understand the house edge, the malicious trapdoor rules you absolutely must avoid, the necessity of diversifying your accounts, and you have a clear, volume-backed playbook. So, armed with all of this knowledge, which prop farm will you conquer first? Thanks for joining me on this explainer. Stay sharp out there, protect your capital, and I'll catch you next time.